Joining us now, former St. Louis Fed President James Bullard. He is now Dean of Purdue University's Mitch Daniels School of Business. Now I can call you. I introduce you as James and then call you Jim. Yeah, welcome, Jim. It's good to have you on. I'll just put this out there. So the Dow's almost at 50,000. The labor market might be showing signs of weakening a little, but for every bad number we get some numbers that say, no, it's not that bad, and it's 4.6%. Inflation may be stubborn, but it looks kind of like it might be anchored, and it could eventually come down. Is this the greatest Federal Reserve in history in terms of managing things that you were part of?
I think the committee's in pretty good shape right now. They've got, on the labor side, I would just stress, Joe, that you've got to take the immigration policy into effect. Some of the estimates that I've seen around the Fed and elsewhere suggest that the run rate with the new immigration policy that the U.S. has starting last year, the new run rate for non-farm payrolls would only be 30 to 50,000 or something like that. So when you get a number like 70,000 or, you're actually above the run rate. I don't think that the market has completely brought that online in their thinking. You know, we're used to thinking 150,000 jobs or something like that. So I think that's been tough. And we didn't have this immigration policy before, so it's all different. So I think that's why the labor market actually, on other indicators, seems fine. You've got unemployment insurance claims, for instance, very, very stable and very low. So there doesn't seem to be any problem on that side. And even the 4.6% unemployment rate, that's close to what most people would say is the neutral rate, or the natural rate of unemployment, mid 4% range. So pretty good outcomes there. And then inflation's hanging up a little bit high, and so the committee wants to stay up a little bit above neutral, the neutral policy rate, to try to continue to push inflation down. And if inflation does continue to come down during 2026 here, then they'll have a little room to maneuver a little bit farther. Not a lot farther, I think. But right now, I think they're in a good place, and they're probably reluctant to move too much from here without seeing more data.
And some of it might be AI related on both sides of the dual mandate. Some of the, the reason that companies may not be hiring as much, but aren't really laying people off as much, that could be AI related. And then, obviously productivity and inflation. Remember what happened to inflation the first time around with the internet? I mean, how long did that tamp down in inflation? Just the long-term effects of the new world.
As a famous episode in U.S. monetary policy, and Alan Greenspan called it. He said, I think we've got a productivity boom going on, and we could be on the cusp of that once more here. And I think the late 90s is a good benchmark. It's that we're not exactly like that, but it's a good benchmark to think about and to look at. And when you think about how the internet, sort of permeated through the whole economy, it did drive productivity, even though you couldn't really point to, particular examples where all of a sudden it did something, that's really noticeable, but it permeates the whole economy, and that's where the productivity gains come from. And the productivity numbers have been good for the last 2 years, and look like they'll probably be good for this year too. So that's pretty good news for the U.S. economy.
And people that want to criticize the current economy say, have you ever seen the unemployment rate rise a half a point and not indicate either a recession or a slowdown? And I hate to say it's different this time, but just what you said, 4.6 is not far in this economy. That's probably not far from full employment. But
I think the way to think about this, it's great to look at macroeconomic history and try to infer things, but this time was a little bit different. You had this gigantic pandemic, and then you had that, very rapid recovery from that pandemic, and that drove the unemployment rate way down into the 3% range. It's the 3% numbers that are kind of abnormal for the U.S. economy. And then that kind of all settled down, and now you're in the 4% range, and that maybe is closer to the natural rate.
Yeah, I mean, Jay Powell, suffers the slings and arrows of the president, but deep down, a lot of the things the president says are bluster. He's always going to want lower interest rates. He's always going to, want it his way. But, I mean, things are in the stock market, job market, inflation, things are pretty good. I think deep down he knows that, President Trump.
Yeah, it's a bit of a mixed message. I think that this pro-business administration has done a lot of good things, and we're looking pretty good for growth. They don't really need the lower interest rates,
No.
and they don't need to take the risk that inflation would reignite here. That would be very troublesome for the economy, for markets, and politically, I think. So that's what you want to be guarding against here, and let the economy run, because it's running pretty well.
What does that indicate to you on who the president picks? That he doesn't need to pick a rubber stamp, and I'm not going to name names, but he could pick someone that is really good at this and would raise rates when you have to, and not raise them not cut them when you shouldn't. Who do you think he's going to pick when it's all set? You think he'll make the right? You think he'll make the right choice?
I think he's got a good set of candidates in front of him, so I don't. There's not really a wrong answer. I think from the president's point of view, all of these people have skills that they can bring to the table and would do, I think, a good job. I don't think that you really need to have this story about driving nominal interest rates, really, really low. I think if you get to a really low nominal interest rate or zero interest rates or something, that probably is not a good day for the U.S. economy. It probably means that something has gone badly wrong, and that's why you're at this super low rate. So I think I don't think the White House probably doesn't need to press so hard on that issue, and you really want competent management, and you want reform at the Fed, which is something that Secretary Bessent has emphasized.
This year and next, bell curve for GDP. What's it right in the center? You think, I mean, 4% would be on the right side of the bell curve. Would 2% be on the left side, or is 3 in the middle, or is it 1 and then 3 and 2 in the middle? Where are we? Have we moved up?
I'd put down a 3 for this year, 3% growth, acknowledging that there are risks out there. But I think there is some upside even to that.
Even to
where
3.
You could get faster growth this year. So I think it will be a good year for the U.S. economy.
That'd be amazing. That'd help with that'd help with that $40 trillion. It's going to be $40 trillion, like next month or something, or like in 4 months.
Yeah, I mean, one thing that happened in the second half of the 90s, you did get rapid growth, rapid productivity growth, and that did help a lot. I mean, I don't want to take Congress off the hook. They do have to control.
Don't say that.